In today's video, we are going to explore a market maker manipulation scenario that happened in the Australian dollar versus the US dollar in a daily time frame. We're also going to see one of the many ways to enter and exit a trade like this using advanced line work. Remember that market manipulations happen in all markets and in all time frames because they are a natural consequence of the inherent supply and demand mechanism of the markets. It's one of the market flaws that emerge when one individual or a small group of individuals have enough capital to nudge price in certain key areas. We have to remember also that there is nothing illegal regarding this type of market manipulation. Market makers exploit the fact that retail traders tend to behave in a predictable manner. That creates the possibility for the market maker to take advantage of some interesting opportunities that appear in certain areas of the chart. Market makers can manipulate retail traders in a psychological way because they know very well how the retail traders think and trade. It's important that retail traders get a feel of how and why this happens because that will allow them to not only avoid being caught in this type of market scenario, but also to profit from it. The real power comes from the possibility of retail traders to stop being maneuvered and start taking advantage of this market flaw. Without further ado, let's begin the analysis of how large traders act in this scenario. Let's begin by taking a look at some key areas in this chart. On the left of the chart, we have a detail that might be glossed over by many traders, but it's incredibly important. The horizontal line shows the first time a high has been broken with a higher low right before it. That's one of the facts that originated the larger upward movement we see here. After that moment, we can see that in the minor flow dimension, the market started to display a very clear running flow formation. Notice how the highs and lows are very well defined. That movement ends up culminating in the area of the chart marked by numbers, which is where we begin to see elements of a market manipulation maneuver. The first thing to notice here is that between number 1 and number 3, the market gets wider and gives sense that the major flow will begin to show the elements of an upward trend, meaning higher highs and higher lows. Notice that this 1, 2, 3 vector is much larger than anything else that came before it. That gives the impression that the market will shoot upwards with high velocity. Another detail that probably catches the attention of any retail trader is the progressively larger volatility runs in the minor flow dimension right before the area in the chart where we have the numbers marked. This is precisely the sort of scenario where dynamic frequency breakouts will work extremely well, since we have a running flow with very smooth transition between price vectors. Up until this portion of the analysis, there is nothing in this market that might indicate the dominance of sellers. All pieces are pointing to the dominance of buyers. That changes completely in number 3 with the creation of just one single bar. That has to do with the specific shape of the bar and its location. Notice that this same bar in a random part of the chart could mean absolutely nothing. This is one of the problems with memorizing candlestick patterns, for example. I have a free course about that here in the channel where I explain the good and the bad side of the candlestick patterns. You can check it out by clicking on the card in the upper right corner of the video. Getting back to the bar in question, notice that its shape is composed by a small body and a very large upper tail. It's important to notice also that the bar closes below the level of high number 1. At one point in time, buyers were up there near the high of that bar, but somewhere along the internal history of the bar, sellers were able to smack the buyers down and make the bar close not only in its lower range, but also below the level of high number 1. That's important to know because buyers in this scenario represent the retail traders who are waiting for price to break high number 1 in order to get long. The sellers we see smacking down that specific bar are the large traders getting in the market due to the large liquidity pool created by a cluster of long retail orders in the level of high number 1. Large traders need these deeper liquidity pools in order to get in the market with very large orders. That implies that the market has varying degrees of liquidity in each level. When retail traders see that bar, they start to think that getting long in that level was not such a good idea, so they start to reverse their positions, and some of them are already stopped out since they tend to use short cash stops. The smart retail trader doesn't go long or short on the breakout of market extremes because that's a terrible trade location. The A smart retail trader must get in the market very near the reversal points in order to guarantee a good risk-reward ratio. Notice that this bar in number 3 creates a point where most retail traders that were washed will remember in the near future. At this point, this notion of uptrend we had so far is also shaken, because now everybody realizes that sellers are much more powerful than what was assumed. It's at this point that we can start looking for a line work to agree with the context we have built so far. We can do that by drawing a pitchfork using number 1, 2, and 3 as the alternating axes. An ideal situation would be the market retracing a little bit back to the area where retail traders got stopped out, more or less where the upper Andrews pitchfork line intersects with the horizontal line that shows the level where large traders got in the market. So let's advance to see how the market reacts. Let's observe a few details here. Notice that what just happened confirmed the manipulation maneuver and signaled an entry to the downside. Notice how the current bar touches the horizontal line that marks the manipulation level and the upper line of the pitchfork that was grounded using the most relevant alternating market extremes. The bar not only touched these two important lines, but it also displayed a large upper tail denoting the strong presence of sellers once again. More importantly, observe that we also have a logical place to put a stop loss order, which is above the high number 3, since it's the origin of the whole manipulation maneuver that gave rise to this trade. If the trade is correct, there's a lot of headroom for price to travel to the downside, but if the trade is wrong, we have a short and logical stop loss order to protect the equity. Let's advance price to see how it reacts. Here we can see how the manipulation maneuver indeed signaled the end of the uptrend, pointing to the precise reversal point. Notice also how price went all the way to the horizontal line drawn in the beginning of the video. Price came back precisely to the level where the uptrend was indeed confirmed. This serves to show that everything in the charts has an explanation, but sometimes the explanation is not so simple or obvious. If you want to understand more about the market maker method, check out my course for the market maker strategy in the link available in the video description. I have other courses related to different aspects of price action as well. You can visit my website fractalflowpro.com to learn more information about these courses and see YouTube verified testimonials from students who already went through the courses and learned the techniques. So that's it for this video. If you like the content I produce, don't forget to support the channel by clicking the like button, subscribing to the channel, sharing the video, and leaving your feedback below in the comment section. Thank you for watching and take care.